All right, Kateryna, why don't you get started?
Good afternoon, everyone, and thank you for attending another seminar. Today, we're going to cover tax aspects of buying and owning a home. We'll make it interactive today, and we'll get to your questions. If you have questions, do not forget to use the chat function that you have available. And Larry, why don't we get started? We have a lot of things to cover today and only 1 hour.
That's right. We have 1 hour today, and we have a lot to talk about today. And welcome. Thank you for joining us. So today we're going to talk about the tax aspects of buying and owning a home. So we're going to focus on that. Here's a little slide about my background. This is my 35th year as a tax professional. But on top of not just being a tax professional, I love talking about taxes and financial planning. I just love doing that. And I'm here in River Shores. So I certainly know a lot about the River Shores market and the market in the peninsula in particular. So I'll share some of my personal insight and what I've learned from my clients all these years that we've been doing this. Here's a list of the many topics we're going to cover today. Buying versus renting, down payment, credit scores, mortgage, second homes, real estate taxes, homeowners insurance, casualties, tax credits, and selling a home. And if you have any questions, go ahead and put in the chat. We'll try to leave some time at the end to go over them. So, when it comes to buying a house, the first consideration, should I rent or should I buy? That's always a question to consider. And I was talking to Kateryna earlier about, we're going through this right now. My son is in college and he's going to college at the University of California in San Diego. Well, what the UCs and the Cal States have done this year is they're no longer stuffing the kids in the dorms doubles or triples. They used to stuff as many as they can, which means they keep the promise of providing housing for students. So now they're just guaranteeing housing for the first year students and for transfer students. My son's a sophomore, so he's out of luck. There's no housing for him. If you're a sophomore or above, you're in the lottery, you're in the lottery. And a couple of his friends did win the lottery. They got a dorm. So we're in the throes of trying to find a place to rent in La Jolla, California. And boy, is that a challenge, because we have thousands of parents looking for a place to rent. Well, the idea is, maybe we'll buy a condo there. Have you seen how much condos cost in La Jolla? No, that's probably not going to be likely in our case here, but that's a consideration people think about is, should I buy a condo for my kid when they go to college? Well, what are the advantages of renting versus buying? Well, the advantage of renting is just the low initial investments, basically the deposit. So if you don't have a lot of money saved up for a down payment, renting makes a lot of sense. Renting in general can cost less money because you're not responsible for the repairs. The landlord is responsible for the repairs. And if you got to leave, it's easy. It's easier to leave. It depends on your lease terms and all that. There's a lot of flexibility. So it's a lot easier to leave a rental property than a property you own, because selling takes some effort and could take some time. Also, insurance costs are lower because as a renter, you have renter's insurance. And I always recommend that you get it. It's relatively inexpensive. It covers all the contents of your rental property and in case something were to happen. So for example, one of my clients has a rental property in San Francisco. San Francisco has this habit of having power outages. And it was a 3-story building. Power outage went out, and then the power went back on. But it doesn't just go on. It goes on as a surge. The surge started a fire in the building, burned from the ground floor all the way up. Well, the tenants lost all their contents because the property caught fire. Well, the middle floor tenant is a lawyer, and he sued my clients. He didn't have renter's insurance. It's like, if he had renter's insurance, it would have bought him his new set of clothes, his bed, his TV, and all those kind of things. So And he wasn't responsible. My clients, the landlords, were not responsible for his TV, bed, and content and all that. So that's something you need to be aware of as a renter. So if you're a renter, always read the lease. And you might be able to negotiate the lease too. So don't just blindly sign the lease. Read it carefully. Make sure there's not strange stuff in there. Like sometimes the landlord will sneak things in like, you're going to be responsible for fixing everything. Well, maybe not. Those kind of things. Because I went through that with my office lease. The landlord was trying to sneak all kinds of stuff in the lease agreement. They forgot they were dealing with the CPA. What do we do as a CPAs? We read everything. we read everything. So I mean, we got it all fixed, but that lawyer was just that landlord was just trying to be very sneaky about that. You got to remember, it's a legally binding document. I know we got some issues with the moratorium on evictions and all that, but you can't rely on that going forward. And also, you need to protect your security deposit. You have to make a deposit. So it's always important. Do a walkthrough before signing the lease and document any pre-existing damage. It's kind of like when you rent a car, right? Don't just hop in the car and drive away from the rental place. You want to walk around it and make sure you look carefully, see if there are any scratches or whatever. Because one of my friends rented a car. He picked it up at 3 a.m. because that's when the plane landed and it was the last car available. But what he didn't know was a big crack in the windshield. And when he returned the car, the rental car company was trying to get him to buy them a new windshield. So, same thing with your rental property. Do a walkthrough before and after. Get it all documented. We have cell phones now. Take pictures of everything and get renters insurance. So, any thoughts about helping a person rent a place, Kateryna?
I think what you covered is basically what is important, especially when you are renting. Read the lease very carefully. And also, as far as the security deposit, I cannot stress enough, it is very important to do the walkthrough before signing the lease. And also in your lease agreement, chances are there is a period that is given to you to document all pre-existing conditions or damages, because sometimes during the walkthrough, it is impossible to operate all the appliances and systems. But once you move in, do keep an eye on all the systems if they are in operating order, and don't be shy in writing an email to the property manager or to the landlord and informing them about everything that may be not working properly, because at the end of the lease, there will be a deduction from the security deposit if you fail to note pre-existing damage. And as far as the renter's insurance, at least when I'm helping landlords to rent out their places, the renter's insurance is a must. Right now, it's a requirement. It also protects both parties.
It's not that expensive. It's really not that expensive, and especially if you have the car insurance with the same company, it's less than $1,000, I think. Sometimes.
And there is one more thing I want to stress out, because sometimes when you are renting a home, then no problem. But if you are renting a townhouse, or especially a condominium, and if you want to use, for example, a barbecue or other things, make sure that you request rules and regulations from the landlord, because it specifies what you can and cannot do.
I've seen those barbecues on the decks, and boy, that makes me nervous. You start a fire or hanging laundry out there or whatever, right? You just got to be careful. Now, how about buying? What are the advantages of buying? Well, the cost of ownership can be less than renting. Why is that? Well, we get a fixed mortgage. So if you get a 30-year fixed mortgage, that number's not going to change for the next 30 years. Unlike rent can go up. So that could help you fix the cost of your ownership. Yes, property taxes will go up, your utilities and all those will go up. However, if you can fix, the biggest number is probably the mortgage. So if you get a fixed mortgage, that could help possibly lower the cost of your housing over time. As the owner, you control the property. You can make changes to it without having to ask anybody about it. For many people, it's forced savings as part of the financial plan. So forced savings. Best way of building wealth in America is getting a home, buying a home. You're paying down your mortgage. As you pay down your mortgage, you're building your equity. So that's a great way of building your wealth. And certainly the tax advantages of owning a home. We have the mortgage deduction, the property tax deduction. Also, we get some tax breaks when we sell the property. So there's definitely some tax incentives for owning a home. We'll talk a little bit more of that in detail. You have the freedom to redecorate, remodel, or make improvements. And also, as being a homeowner, you make your timely mortgage payments. It improves your credit rating. Your credit score improves on that. And this frees you up from the risk of rent increases. So one thing to consider when you're buying a house, a lot of mistakes people make when they're saying, hey, I want to buy a house. All they factor is the cost of the mortgage payment. That's the only thing they look at. No, you got to look at the other costs of ownership of a home, not just the mortgage. You got property tax. You got to understand how to calculate the property tax. how much that's going to be. You got to factor that in your budget too, because you don't want to get in trouble of not paying your property taxes, the cost of insurance, maintenance and repairs, what condition is the property in, association dues, and we'll talk about that a little later. And of course, the downside is there's less flexibility to move. It's kind of hard to, it's not like a stock where you just go to the stock market and sell the house. There's some effort to sell. And I've been doing this for a long time. So I've seen the markets and home prices fluctuate. There's these real estate cycles, cycles up and down. We've been through a few of those cycles and we've seen how they go. So, I think the key is controlling your emotion when buying a house. And that's Kateryna's job, is dealing with people's emotions, right?
Exactly. There's especially on the residential side, there's a lot of emotions involved. And one of the things is there is a saying, the more haste, the less speed. And then always have a cool head and write it down. That's why it is important to do your homework in advance. And if you're in a market to buy, first of all, decide if you have a budget. Can it be all cash? Do you need a pre-approval? Determine your budget and then stay within within that budget. And also do not overlook the cost, because quite frankly, people only look at the cost of the mortgage and they forget about the property taxes. They forget that there is also a supplemental tax that will catch up with you one time. There is also insurance, maintenance and repairs, and of course, association dues. And one thing we will touch on association dues, but one thing I want to stress out, if you are buying a home in the that has a homeowners association, do read the budget so that you are not surprised of special assessments that may be on the horizon. So make an informed decision and read everything up front.
That's right. And talk to your tax advisor. I mean, you might not agree with them. I went through this in the mid 2000s. It was crazy in the mid 2000s. People woke up in the morning and say, "Hey, I'm buying a house." I said, "You're not ready to buy a house." They bought one anyway. Well, they bought a house they couldn't afford, and people got these what they call negatively amortizing loans. Those are terrible loans where your mortgage payment was less than the amount of interest, so the mortgage kept growing and growing. So yeah, just be careful of the people are trying to force you to buy a house when you're not ready to buy. So you just got to be careful about that. So yeah, all these considerations to think about. What's your time horizon? What's your time horizon of being in the home? What if you're I still remember when I was in my 20s, I just got out of college, and am I going to stay here, or am I going to try another location, or is my job going to move me to another location? That could cause some challenges here, because real estate cycles, there's a cost to selling a home. Am I going to lose money if I sold a home? We always think about a 5-year time horizon probably, and affordability. We've seen articles about that. In today's Chronicle is a big article about affordability of rent in the San Francisco area. How much do you need to make to afford an average home? Well, the financial planning rule of thumb we look at is we'd like to keep your housing costs to 1/3 of your income, 1/3. But Americans over the United States is about 37%, so that's a little bit more than a third. But unfortunately, here in the Bay Area, it's over 50%, and I know a lot of people spend more than half their monthly budget on just housing costs. And how do we improve on that? Well, maybe we get roommates, or stuff more people in a house or something like that. But we can get creative about that. So let's talk about down payment. So generally, you're going to need a down payment to buy a house. You can't just walk up to a house and tell Kateryna, "I'm ready to buy. Do you have any money?" No. So we got to think about down payment. Things have changed since the mid 2000s. Before, it was pretty wild. You got houses with no money down, or in some cases, negative money down. We had some pretty crazy situations in the mid 2000s, which caused that financial crisis we had in 2008 and 2009. So generally, it's if you can put down 20% or more, it increases your chances of getting approved for a mortgage at a good rate. If you do less than that, it'll cost you more. It'll be a higher interest rate, higher cost, and then also pay for mortgage insurance. The mortgage insurance is not to protect you, it's to protect the bank. And it's an extra cost that you will have to incur. But there are types of loans where you can put down less than 20%. There's FHA loans, which is the Federal Home Administration, and they have programs where you can go as low as 3.5%. Or if you're a veteran, There's what's called VA loans. In many cases, there's no down payment requirement. It's for current or veteran military service members and their surviving spouses. There's USDA loans. That's through the U.S. Department of Agriculture's Rural Development Program. So we don't see too many of those here in Foster City, but we'll see those probably in the Central Valley. No down payment requirement. Rural, suburban home buyers who meet the program's income limits and all that. There are a lot of programs that help people with borrowing. I mean, through the school district. It's not going on right now, but a few years ago, the San Mateo Foster City school district had a teachers program to help them buy homes, and basically it was a deal to help with the down payment. San Mateo County had a mortgage credit program, so you got a credit for the mortgage. So those are in the past. We currently don't have those now. There were times where we had what they call BMR, below market rate properties, affordable housing. So if you meet certain requirements, you can get those with either very little down payment or whatever. But there are strings attached. You know, if you sold the property, a portion of the money is going to go back to the program to help buy more properties. So there are all kinds of different down payment programs that you can look at. But you know, the bottom line is the larger the down payment, the better the mortgage interest rate, lower fees because you have a smaller mortgage, mortgage insurance, you can avoid that. That can be quite costly. You have more equity in the home with a larger down payment, lower your mortgage payment. And if you have a lower risk to a lender, that's how you get the lower rate. So we always had a question, you know, how do I save for a down payment? How do I save for a down payment? Well, start early. And I was telling Kateryna my story is that after I graduated from college, I was working for a large CPA firm in downtown San Francisco, but I stayed home, my parents' house, because if I moved to San Francisco as a 20-something-year-old, I would have not saved a dime. And basically, I banked as much as I can, and that got me my down payment for my first house here in River Shores. So, you know, it's a lifestyle question. If luckily it was okay for me to live with my parents. They tolerated me, so that worked out okay, and helped me buy my first house. So that was great. But how do we save our down payment? Try to make it automatic. You know, take a look at your paycheck. If you can have some money go into savings at every paycheck, if you can do that. Windfalls, you know, we get bonuses. Many people here in Bay Area work for companies that give you employee stock. It could be stock options, restricted stock, employee stock purchase plans. Great source of a down payment. So take advantage of that, especially if the stock goes up. That's really helpful. So that's a great way of building up your down payment. If you get windfalls like a tax refund, gifts, inheritances, sometimes your parents might be able to help, or family members might be able to help with the down payment, those kind of things. But you know, it's all part of it, right? So do you have any other creative ideas for helping clients build a down payment, Kateryna?
I can share one experience. I helped this young couple. They just moved to the United States, and they were renting for some time, and they both had good jobs. And what they did, they had a dream to buy a single family home, but it was not possible because they were just in the early phase of becoming a homeowner. So what they did is they were very smart in selecting a good location, and they ended up buying a condo in Foster City. It was a 2-bedroom, 2-bathroom. They owned it for 3 years, and they were able to sell it, and they walked away with $200,000. And they were also using that money to buy a single family home, which they did a few weeks ago. So you see, in this one, it was a success story. They started early, they were renting, figuring out their job situation. Then they spent the time and they bought a home. It was a simple condo, but in a great location. And then they lived, they enjoyed it. And then they also were lucky to get the appreciation that helps them to build up that down payment and made it possible to buy a single family home.
Yeah, that's a great success story. I love hearing those stories. And we have quite a few clients who've done that. You know, they start with the condo, then they're newlyweds and they get a single family home. pay down those mortgages, and then move up to a larger home. And it's the American dream, isn't it? So
Yeah, one step at a time,
one
and
step at a
then,
time.
you know,
Yeah, your
sometimes,
first house is not going to be that $3 million
yeah.
house, but some people do that. So how to save for down payment? I mean, people are saying, and this is what really bothers me about the media. You turn on the TV or you hear the media saying, "Oh, it's impossible to buy a house in the Bay Area." Oh no, it's not impossible. It is very possible with people with normal incomes. We're not talking about these tech millionaire types who, it's not just for them. It's for everybody. But what do you have to do? You got to review your budget, review your spending, and also be realistic of what it costs to own a home. And that's what I do with my clients. We run the numbers. We do the math of here's what the mortgage, the property tax, insurance. Here's what it costs to own a home. Here's what the tax savings are going to be. Okay, here's the number we come up with compared to your rent. Okay, the difference is $2,000 a month. So if you own a home, it'll cost you $2,000 more a month. Can you handle that? Well, if the answer is yes, then that tells me at minimum, you should be able to put away at least $2,000 a month into your savings. So that way your cash flow is what it would have been if you bought a house, something like that. But, cut out or reduce unnecessary expenses. Eating out a lot can be kind of expensive. Lower your costs, learn to cook, budget carefully on vacations. I see people take very expensive vacations. You don't have to. You can still have a lot of fun at low cost. I mean, well, I'm the wrong person to talk to, but I can get creative about that. Review your expenses, see where it's going, and then direct it towards your home purchase goal. Pay down your debts, pay off the highest interest rate debts first. Take a look at the snowball effect, the whole high costs. And because by getting rid of those high interest debts, it can help improve your credit scores too, because if you have too much debt outstanding, that can hurt your credit score. You're young. These young people, you're energetic. What are you doing in your so-called downtime? Get a second job. We got this nowadays. We have the gig economy, and it could be quite lucrative too. So I've known people who take up a second gig, and that second gig, 100% of that money goes towards their down payment fund, and that's a great way to go. Well, where else can you find money for a down payment? Of course, savings, that's putting money in there. Grant money assistance. So take a look at your job. I mean, I know in some of the cities around here, there was some talk about city workers, police, fire, city employees, trying to help them with their first-time home buyer assistance. I don't know of any right now as we speak, but they've come. And I know there's a budget surplus in Sacramento, so we'll see what kind of first-time home buyer assistance programs are going to be popping up. So keep an eye out for that. I don't recommend this, but you can take $10,000 from your IRA account. Only your IRA account, not your 401k, 403b, or 457 plan. Only your IRA account. If it's two spouses, that's $10,000 plus $10,000. You can take it out of your IRA for down payment of homes. That's $20,000. It's penalty free, still taxable if it's coming from a traditional IRA. Now, if you want to take it out of a Roth IRA, it'll be tax free. However, that Roth IRA has to be in existence for at least 5 years. 5 years for it to be considered a qualified distribution. So you got to watch out for that, but that's available to you. Now, if you're working for a company and you have a 401k plan, you can borrow up to $50,000 or 50% of the balance of your retirement plan at work, the 401k or 403b. Again, it's not free. There's an interest rate. The interest rate is determined by the employer. And so it depends on what your employer does with that. I don't know what it depends on which company. Some companies are at 4%, some are at 6%, but it is a source of funds. The risk of taking a 401k loan, though, is that if you leave that company, you have to pay it back. If you don't pay it back, it's taxable as a taxable distribution, which means subject to tax and penalty. So it's available, but just be careful about that. So let's talk about credit scores. So that's really important because the better your credit score, the better your mortgage. Because you hear all these ads on those great mortgage rates. Well, this is for people with perfect scores. If you have bad scores, you're not going to get a great rate. So credit scores are important. It's going to affect your credit card rates, your car loans, your rental applications, job applications, right? And mortgage rates. There's the credible website, the annualcreditreport.com. You get a one free credit report every year. Annualcreditreport.com gives you access to the 3 credit agencies, Equifax, Experian, and TransUnion. Now, they're not going to be identical. So if you go through Equifax, you might not see this exact same data as Experian. They might not have the same data. They calculate the credit score a little bit differently. So one might have a higher number than the other. So you might not get the same number in all three of them, but it gives you an idea where you're at. And it lists, you go through your credit report, it lists all the loans that you've had, the amounts that you've had, if you paid on time, or if you missed any payments. So if you made any mistakes, it gives you a chance to go fix them. And yeah, the credit scores are competed with different formulas with these different companies, and not all businesses report to these bureaus. So for example, some people, like Kateryna was saying, these young people, they didn't have much of a credit history. So what's interesting, if you're renting an apartment from one of the large landlords, those big apartment complexes, those big national companies, they actually will report to the credit bureaus showing that you're paying your rent on time. So that would help. They would actually report it. But if you're renting from like a mom and pop landlord, they're most likely not going to be doing the reporting to the credit agencies. So, so that helps. If you have a credit card, you pay it on time. If you have a car loan, paying it on time, that always helps. So it makes your scores go up and down. How much you owe on those cards gets, it's a math ratio, right? How much outstanding versus what's available, how long you owed it, how many accounts you have. So don't get crazy about opening credit cards everywhere. If you miss any payments or late with payments, and the type of accounts. So scores, it's kind of a range here. So if you're in the 700s, that's pretty good. That's where you want to be at. Yeah, I'm not gonna give someone a loan if they're in the $300 range. That's kind of bad. But look at your report. I mean, before you even get the mortgage, look at the report, make sure there aren't any mistakes on there. Now, there's some negative stuff that can be on your report. There's any liens there, any judgments, bankruptcies, that's there for 10 years. 10 years. If there's any tax liens, that's there for 15 years. So that's why it's important to stay on top of your taxes. I mean, that's there. I'm going through these topics kind of fast because we got some other more interesting topics to go over. So we're going to talk about mortgages here really quickly. I'm not a mortgage broker, but you do have a choice of different types of mortgages. And in general, I like my clients going to a mortgage broker, because a mortgage broker doesn't work for a specific bank. They work for different lenders, and depending on your situation, they work for you. So they help you find which loan makes sense for you. It depends on what your goals and your plans are. So not everybody should get the same loan. Versus you go to a bank, you're limited to the products that the bank sells and their rates and all that. So, and you're filling out an application with them. But if you go through a broker, they can shop the different lenders, and the answer changes on a daily basis sometimes. And, this bank might give you a better deal than that bank. So, it's a matter of picking the type of loan we're looking for. There's fixed loans. That means the rate's not going to change for the life of the loan. There's adjustable loans, and they will adjust depending on the terms of the loan. It could be 5-year fix, 7-year fix, or even 1-year fix. So some could do that. And the amortization of loans, some are interest only loans, which means there's no amortization until later. Amortization means paying down principal. So that's what that is. And of course, more importantly, is the appraisals, right? So if you're making an offer on a house, the appraisal should be able to support that. So I'm going to stop here to let Kateryna comment, because Maura's got a question about what credit score zone is good for buying. So I'm not a mortgage broker. So Kateryna, what do you think? I mean,
I think it's safe to say if you are in good and excellent zone, that you would have better chances of getting a good loan terms.
Exactly. And I think it depends on the time horizon of the client too. It depends how much risk they want to take. If you know that I'm just going to be here until the kids are out of high school. Maybe we want a fixed loan for 7 years or something like that. Because usually with these adjustable loans, you do get a slight discount. The rates could be a little bit lower. But then you're taking a risk because the rates are going to adjust after the fixed period. And we don't know where that's going to be. Rates are at historic lows right now. So it's really compelling for a lot of people to look at fixed loans right now, which makes a lot of sense if you want to stay in the loan. So let's talk about some other things to consider when getting a mortgage. Part of it's what can you afford? And also, take a look at the loan calculators. It's on a lot of the bank's websites. You plug in what the balance is, plug in interest rate, and the computer will calculate what the monthly payment will be. That would be very helpful. Or sometimes I'd say it's $4.88 per $1,000. Just multiply the size of the loan by that. So let's talk about some tax rules of mortgages, because I'm a tax guy. I love talking about taxes. So one thing is points, mortgage loan points. Should I pay points on my loan? And like any answer I give, it depends. So what are points? Points are prepaid interest. So some banks say, hey, if you pay us an extra point, we'll give you a lower rate. If you pay a lot of points, we'll give you a much lower rate or something like that. So that's something to consider, something to think. Are you willing to prepay some interest? Now, if you are paying points when you're buying a home, it's deductible. So I'm going to make up a number. Let's say we paid $10,000 in points getting a mortgage. That's going to be fully deductible, not subject to any limitation where it's fully deductible, as long as it's used for a purchase, construction, or improvement of a principal residence. So for example, I already have a loan, but I'm going to refinance, but I'm going to pay a point, but it was for paying off the remodel of my house. That'll be okay. It'll be fully deductible. So the terms are, it's got to be secured by the home, of course, and it's the accepted business practice, and the amount that's being charged is consistent with what the community is charging. So, most points I see is not really that high, maybe 1 point, half a point, 2 points, usually nothing above that. If you see someone charging 5 points, I would question that. However, if you're refinancing a mortgage and paying points, you'll have to amortize those points over the life of the loan. So if it's a 30-year loan, it's amortized over 30 years. That means we deduct it over 30 years. Okay, so that's the thing about points. It's analysis we do. We do a break-even analysis, and it changes all the time. It depends on the market, depends on what the interest rate market is on that, and we do the math on when it's going to break even. If I paid 1 point, I get this lower rate. I'll do the math. I'll say, you break even in 18 months. That means if you hold this mortgage for at least 18 months, you'll be ahead. However, if you pay points and you refinance 2 months later, you're not really getting your money's worth. So, we do that break-even analysis. Yeah, so for the tax rules, there's some really interesting things about points. It's not subject to the mortgage deduction limits. The IRS, a lot of the IRS employees don't know that, so you have to remind them that. And then when you're refinancing, if there's any unamortized points on the old mortgage, you got to write those off. So for example, let's say I paid $3,000 of points to get my mortgage. My last refinance, I refinance again. There's still $2,000 left on that to write off. I refinance, I get that $2,000 deduction. So that's where that is. So what's the really important tax form that we look at? It's not the year-end statement. That's a mistake a lot of people make. So the number you see on the year-end statement is not necessarily the number on the form 1098. So 1098 is the form we get from the bank that reports the interest deduction. And that's the number that the IRS gets too. So you should be reporting the same number. And I'm glad a few years ago, Congress passed a law to require mortgage companies to provide this information to comply with the mortgage limitation rules. This was done to raise money, raise revenue, and it was billions of dollars because people were deducting more than they should. Well, now on the Form 1098, box 1 is the interest that was paid. Box 2 is what the mortgage balance is, and that's important because of the mortgage deduction limits. When the mortgage was acquired, that's a very important date. Box 5 is the mortgage insurance premiums. Box 6 is any points that are paid on the purchase of the principal residence. And box 8 is the address of the property securing the mortgage. And that's really important too, because to deduct your mortgage, it's got to be secured by your house. It can't be another address. Let's talk about deductions here. So the laws changed for 2018 to 2025. Home equity interest, if you have a home equity loan, it's not deductible unless that money was used for the construction or improvement of your home. So look out for that. So for mortgages that are acquired after December 15th of 2017, that's when the new tax law took into effect. The deductible limit of the mortgage is $750,000. So for example, we're seeing people getting $1.5 million mortgages, right? Just bought a house, $1.5 million mortgage. Well, only the first $750,000 of that interest is deductible. So in that example, half of the mortgage is deductible, half is not deductible. Now, if you get your mortgage before December 15th to 17, that's considered to be grandfathered, and the deductible limit is $1 million. So if I have my mortgage that I got before December 15th of 2017, and the balance is $900,000, it's 100% deductible, even though it's more than 750, but less than $1 million. So it's only deductible by the owner of the property. And I think there's some questions about cash buyers, right? So there's some careful tax rules we got to have. So if you're a buyer is fortunate enough to be able to write a check to buy a house, that's great, wonderful. And then you change your mind, you say, you know, I want a mortgage on this house. I paid cash on this house. The way the tax rules work is if I refinance to get a loan on that house, let's say a few years later I decide to do that, it's not deductible. So we got to be careful of doing that. However, there's a 90-day rule. So if I paid cash for a house and I refinance to get a loan within 90 days, that will be considered a mortgage, and a mortgage that would be deductible. So it's that 90-day window we got to look out for. So the mistakes we see is people pay cash for it. A year later, 2 years later, they decide to get a mortgage, and then they think it's going to be deductible. It's not. It's not. And the IRS knows, right? They know when you bought the house. Home purchase information is public information. And the IRS manager in charge of auditing this, he's a very smart guy. So he knows how to use Zillow. So Zillow has a lot of this information on the website, type in the property. So he can check. And so don't try lying to an IRS agent about this kind of stuff. So we've got some questions about who gets the deduction, right? That's a tricky situation because, you know, we might not be able to buy the house on our own. We might have to get our parents to help us, or maybe luckily have a friend to help you buy a house, or some other person, right? So who gets the mortgage deduction? Well, the person who gets the deduction, you have to meet two rules, basically. It's for whoever makes the payments, right? Whoever makes the payments and is the legal or equitable owner of the property. So for example, you're a great son, you're a wonderful son, but your mom's got a mortgage and she can't pay it. So you're just going to pay her mortgage for her. And you tell me, hey, Larry, I paid my mom's mortgage. Here's her Form 1098. I'm going to deduct it because I paid it. I said, but you don't own mom's house. You're not the owner of the house. Yes, you paid it, but it's not deductible to you because you're not liable on the debt. You're being a good son. God bless you. You're a good son, but there's no deduction there. So you got to be generally you'll be liable on the loan. So there are some really interesting fact patterns where sometimes you would still be liable on a note, but then you don't own the property anymore. So, you know, so it's whoever's actually making the payments. So we got to take a look at the fact pattern and be real careful on that. That's why the 1098 is issued to a specific Social Security number. So you'll definitely get a letter from the IRS if you're deducting interest on a loan where your Social Security number does not show up on the 1098. So, you know, we got a lot of joint owners of the property, you know, so we're joint owners of a mortgage property, are jointly liable on the mortgage. So if, you know, let's say you go in a house with somebody, you're not married to that person, but you go into a house together, you know, you can split the interest between the two of you, you know, if it's being paid out of a joint account or something like that. So mortgage deductions can be quite tricky when you're dealing with multiple people, or you have parents who are buying a home, and then there's always a question of should the parents be entitled or not, right, Kateryna? It's that gets really confusing, but we got to be real careful about it too. So you know, so we could talk about this in more detail. I just want to put the slide here just to let you know there is some details on that. So, you know, so this came from some court cases. So the taxpayer doesn't own the property. The mortgage on the personal residence is only deductible if there's an ownership interest. So, for example, it could be mortgage on a rental for property. He's still liable for the mortgage debt. So he can still deduct the mortgage interest payments that he paid with his own money. But so there's some other cases where this is very common. The parents, I don't know what the legal word is. I don't know if guarantor is the right word anymore, because I think they changed that term. But let's say the parents help the child get a house. So and the way the promissory note's written, they're not personally liable on the note, but it's only the legal or equitable owner of the mortgage property, only if it's the legal owner, equitable owner of the mortgage property can deduct it. And this is a lot of times the parents are on the or get the house together with them because the kid has no credit or they have bad credit. But the tax court has this further reasoning, because that you look at the promissory note. So even though you're not personally liable in the debt, because if you look at the promissory note, it says Sally must pay this amount, but doesn't mention the parents. But the tax court looks at, well, where does the bank go if the daughter doesn't pay? Well, if the bank forecloses on the property, you can lose the property. So that's the reason the court took in that case there. So you got to check the terms of the promissory note with the mortgage, So you might not be the legal owner. You go to the deed of the property and your name might not show there, but you could be considered in tax terms the equitable owner. What's an equitable owner? That's someone who has the benefits and burdens of ownership. Even though you don't legally own the property, but you have the benefits and burdens of ownership. You have the right to possess the property. You enjoy its use, rents, or profits if it's rented out. You have a duty to maintain the property. You have responsibility for insuring the property. You bear the risk of loss. You're obligated to pay the property taxes, assessments, or charges. You can improve the property without the owner's consent. And the right to get legal title at any time by paying off the balance of the note. So it doesn't and it doesn't mean that you have to live there either. It doesn't have to be your residence to be an equitable owner of a property. So this could get a bit complicated. But it's something to think about, right? Something to think about. Other deductions we have is mortgage insurance premiums. And so that deduction kind of comes and goes. So it's back. It's good until the law is good until the end of this year, December 31, 21. It got extended through the most recent tax change. So which means in 22, it'll disappear, but it might come back. It depends on what happens in Congress. There's a phase out of that the deduction. So it gets reduced 10% for every $1,000 over $100,000. So if your income's over $109,000, if you're paying mortgage insurance premiums, it's not going to be deductible. So if your income's below $109,000, then you can get a mortgage interest deduction. I think that's our end of the mortgage discussions. Do you have any comments on mortgages, Kateryna?
Not really. I think the one word advice I would like to give to our attendees is have a conversation with your CPA, have a conversation with the lender, and to know exactly your numbers, and don't look at just at the mortgage cost, but look at the ownership cost. And there was also a question, what does really paying cash mean? I guess it is when you are in a position to buy the house and you do not have to resort to finance it.
Yep.
So if you have all this, I can share with you one situation. For example, I have a client and they were looking for a dream house. And as you know, a dream house is very difficult to get because you have to pay for the premium price. So what they ended up doing is they bought a fixer-upper that they were not able to get financing on it. They paid all cash and they got a very good price on it. And then they were using a 90-day rule and they basically refinanced it because by that time they were able to speed up and do all the necessary repairs that were needed to qualify for getting the financing. So the first part of the transaction was all cash, but then they were able to refinance and get a loan on it.
Yeah, you got to watch the 90-day rule, and
Yeah.
so basically you don't really have a whole lot of time because it takes time to get a mortgage processed, and so you got to be real careful about that. But let me bring up a very common pattern that I see quite often. So maybe you found that house that you really really want, but you still have your existing house, but you can't sell your existing house yet or whatever. So you were able to buy the new house, get the minimum down payment you can, and have a very large mortgage. And that's a very common fact pattern. But you're going to be able to sell your existing home, but you don't know when that's going to happen because house is not in the greatest shape, and it's going to take some time to sell. So I told my client who's in this situation right now to talk to the lender to to see if you can add what's called a recasting feature to the loan. Recasting. So what recasting means is, let's say I buy the new house. It's a $1.5 million loan. It's a great big loan. And when I sell my house, I'm going to take that money and dump it into a mortgage. So it brings it back to the size it was on my old house. So whatever the cash is goes into that. However, if it's not a recasting mortgage, the payments stay the same. It's still based upon a $1.5 million balance, even though the loan's much smaller now. If the bank, and nearly all banks have this, it's called a recasting feature. If you don't, most people don't need it, but if you do need it, you ask for it. If that lender says no, go find another lender. This is why one of my recommendations is generally, this is why I like working with a mortgage broker. They have access to many lenders, and they all have different features and different terms and conditions that we can use. So you might want to find a loan that has a recasting feature, which means when you sell the old house, dump a bunch of money into the mortgage, they'll recalculate it. So for example, they get $1 million from the sale of the old house, dumped into the new mortgage. So it goes from $1.5 million to 500. So now it's a $500,000 loan. Recasting means they'll recompute the payments based upon a $500,000 balance. Certainly much more affordable than a $1.5 million loan. So that's one feature. Some lenders have another feature called portability. So there are some lenders have that's called portability because rates are super low right now. It's a great, you might have that beautiful 30-year mortgage. Well, if you sell your house, that loan gets paid off, you're going to lose that 30-year mortgage with that great rate. Then you have to get a new 30-year mortgage at whatever rates they are at the time you do that. Well, some banks offer a portable loan, which means you get to keep that same loan. So for example, it's down to $500,000 now. I buy another house, the new house, the loan's now $700,000. Well, the first $500,000 is still the old loan. The bank made it portable, carried over, and then the $200,000 additional month you have to borrow is subject to the current rates and all that. So you can get very creative with your mortgages. So don't assume you have to take what the bank gives you. You can be very creative. So it's very, very important to think about. And also once you get the mortgage and all that, talk to your tax advisor to review your withholding and all that, to see if you can adjust your withholding because you get the additional tax deductions. Otherwise, you have large refunds, and might as well get the money now instead of waiting for the refunds to come. All right, second homes and vacation homes. We're not going to spend a lot of time on this, but you could have a second home. What's a second home? Well, that could be another property you own, and you rent it out for less than 15 days during a year. That could be considered a second home. Now, just remember, I'm using tax terms here. When you talk to a bank or a lender, they have their own language. So their definition of a second home would be different than my definition of second home. So you got to be careful what they're saying sometimes, because if you talk to a bank, their idea of a second home is that a home's got to be more than 50 miles away. So that's what a bank's definition is. That's not a tax definition. Same thing with vacation homes. A bank would have a different definition for vacation home. The reason they have their own definitions is they set their rates based on the type of property. So it's going to vary based upon that. And you don't want to lie to a bank, especially if you're going to buy a rental property and tell the bank that you're going to live there, and then you turn into a rental. And I don't know, that could create a problem because generally a mortgage on your principal residence is cheaper than a mortgage on a rental property. Excuse me, one more cough. So for tax definitions, a vacation home definition is it could be a home that you personally use and is rented out. That's like your, it could be a second home, like your second home in Tahoe or the lake or whatever, and you rent it out for more than 14 days. So here's the tax break you have. If you rent out your house or your property for less than 15 days, that rent is tax free. So if it's rented for 14 days or less, fewer than 15 days, then people took advantage of this. For example, the Olympics was in Los Angeles, right? So a lot of people in that street where all the runners were running on that street, they rented out to people who want to go see the Olympics. Well, they rented out for less than 15 days and they rented for a lot of money because there's no more hotel rooms. And that was tax free. So you might want to consider that. I don't know if you can do that with Airbnb or not, but just got to watch out for that. Now, a vacation home is a home that you personally use for more than 14 days or 10% of the rental days. What that, from a tax standpoint, means with a vacation home, there's no tax loss. A rental property is a property that you have basically no personal usage or less than 15 days or less than 10% of the rental days. If you run a loss, you get a loss on the property. And this is all reported on your Schedule E. So it could be the same property, but the tax definitions can change over time. Depends on what you do with them. So if you have your home, you rent it out for 15 days or less, the income's not taxable, but there's no deduction though. There's no extra deduction because it's not taxable. Vacation home, short-term rentals, there's these taxes you might have to pay if it's a short-term rental. And luckily Airbnb and VRBO kind of takes care of that for us now. You have to do an allocation of the business usage versus the personal on your Schedule A and your Schedule E. Gotta watch out for that. With a rental property, there's a very special tax break that if the expenses exceed the rental income, you can claim up to a $25,000 passive loss deduction. Now, during the campaign, President Biden wanted to get rid of this tax break. Well, and the current legislation that's going to Washington right now, no mention of this change. So we'll see what happens. So we might still get to keep that $25,000 passive loss deduction. All right, let's talk about real estate taxes. At the end here, we'll have links to the webinars we did earlier. So back in January, we spent a whole hour talking about Proposition 19. So we're not going to go into detail here about that, but just to let you know that the property taxes are imposed on the real property. And like Kateryna mentioned earlier, when you buy a home, usually the price you pay is more than what the current assessed value is on the property. There will be a supplemental bill. The supplemental bill gets the property taxes up to the value of the property that you got that you paid for it. So got to be aware of those supplemental taxes. So you a lot of times what happens is you buy a house, the previous owner's been there for 30 years, and the bill's really small, and you go, yeah, this is great, I can afford that. And then a few weeks later, boom, you get the supplemental. It's like, oh no. Well, that's what it's really all about. Now, if you make improvements to your property, where you had to get building permits or you add square footage to your house or something like that, you'll be hit with supplemental taxes. So that's when your property tax could increase. And that's a good question that some people have too. It's like, I have my house right now. I could either go sell this and buy another house, or I can improve my house. Well, generally, if you improve your house, your property taxes probably be lower than what's going to cost on the new house you buy. So that's something to consider of what I'm paying right now for my property taxes versus what my property taxes will be in my new house. So you get an idea what that is. And then, of course, in November, the California voters enacted Proposition 19. And there's two parts to Prop 19. The good part, that's the part you saw in the TV commercials, and then the bad part, the part they didn't show on TV. So the good part makes it a lot easier for you to transfer your assessed value to another home. It's really loosened the rules on that. That's the happy part about it. The hard part about it is when you inherit real estate. When you inherit real estate, there's going to be a reassessment. There's some exceptions for a principal residence, but you have to live in there. So that's what that's considered. You have a comment, Kateryna, on this?
I just want to make the attendees aware, and some of you may have attended our Proposition 19 webinar, and we will share with you the link. I believe you have the link included in this presentation. So
Yeah,
especially if you are 55 plus and there are certain requirements to meet Proposition 19, but this is really created an opportunity for people to keep their property taxes, existing property taxes, and move up or move down.
Right, exactly. So property taxes is one of those bills, mortgage, property taxes, and then homeowners insurance. So it's important. So your insurance agent could be your best friend. I mean, we were my wife and I just we got our bill for our insurance, and the agent says, hey, there's some changes here if you select this and all that. Because the hot topic is replacement costs, right? And tragically, we've gone through wildfires here in California, so that's a big deal. One of my clients' houses burned down on July 4th. These evil kids were launching fireworks in Redwood Shore, and guess what? Fireworks are illegal, right? Right? They're launching fire, landed on the roof, poof, burned the house down. So not a good thing. And I saw the news. I go, why does that address look familiar? Oh my God, I know that house. So bad thing. It's no fun. Actually, across the street from me, my neighbor's house caught fire. He had cardboard stacked next to his water heater. So spontaneous combustion. So all the neighbors heard about that. Everyone ran home and checked the water heater, make sure there's nothing close to the water heater. I mean, and the thing is, it took almost 2 years for them to move back into the house. So it's not an easy thing. So, make sure you look around your house and make sure it's fire safe, so the stuff doesn't happen. But we really do think insurance is important. It protects against interior damage, exterior damage, your personal assets, and the injuries that arise on the property. That's for the liability part. So if you have contractors working in your house or whatever, and I've had cases where I had contractors who fell into a hole on a property, or there's one client who was a contractor working on a house, and the plumber was doing something, and a spark set the house on fire. And I've seen a house catch fire. It literally takes minutes for a house to burn down. The homeowner forgot to renew his insurance. Boy, that was a difficult one. Because he was remodeling his house. The bill probably came to that address. He was living somewhere else when they're remodeling. He forgot to renew his insurance. So that was a real difficult situation. What does homeowners insurance not cover? Neglect, failure to maintain property. So that's where the insurance adjuster is going to blame stuff on you. Termites, insect, rodent, bird damage, rust, rot, mold, and general wear and tear. It's not going to cover that. Some consideration, make sure you have adequate coverage. So it's going to be really important. Review your policy carefully. Does it cover replacement value and all that? Make sure you have the right kind of insurance. So for example, you have a principal residence, but you move out and you decide to turn to a rental property. So you want to make sure you have a rental insurance policy. So there are different types of policies. Make sure there's an inflation adjustment rider, because sometimes some policy says, yeah, we'll pay $300,000 to rebuild your house. Well, that made sense 20 years ago, but maybe it doesn't cost $300,000 today. Or building codes. Building codes change all the time. So you want that provision in there. Take a look at what's excluded. You can try to save some money by trying to keep the homeowners policy with the auto insurance policy. Also, I usually recommend getting an umbrella liability policy. It's not that expensive. But it's an umbrella. It covers the liability. I always recommend a minimum of $500,000 liability coverage for your auto and home. People sue a lot, so you want to have that coverage. Talk to your agent about that policies are all consistent. They're written the same basis. Are they in claims made, or are they occurrence basis? So that's kind of important. This was an issue when you're buying a house. People didn't look at the insurance. It's kind of like an afterthought. I don't think so anymore. I went to a presentations with an insurance expert, and he showed a normal looking house, and he asked us, what do you think the premium on this house is? And we go, $1,000, $55,000, because it was in a fire zone. So it was like, he said so many real estate deals were killed because of the insurance issue. One, you couldn't find an insurance policy, or it was way too expensive. So before spending a lot of time and energy on buying a house, I would make that one of the first questions. A client want to buy a place in Truckee, right? Or Tahoe. Well, what's up there? A forest, right? I said, well, before you buy that house or make an offer, find out what the insurance is going to be on that, or can you even get insurance? So that's kind of important. Make sure you get all the discounts you can get. I mean, there's a smoke detector, a monitor smoke detector, fire extinguishers, deadbolt locks, a security system. Go through the discount list with the agent, make sure you get them, and review the deductibles. If it's too low, it makes the premium high. See how high you can go where it makes sense. So that's very important. So deductibles are self-insuring. You'll pay for that, because hopefully you'll never make a claim on your policy. All right. Speaking of disasters and all that, I'm going to spend a few minutes on casualties, because when you own a home, things can happen to you. The tax law has changed. So for 2018 to 2025, you could only claim a casualty if there's a federally declared disaster. And there's a website on the FEMA website that shows you what disasters are there that would qualify. So if your house just burns down and you have no insurance and it's not disaster zone, there's no deduction. So that's the big change in tax law. So that's something we got to be aware of. And talking about casualties, it's damage, destruction, loss of property. It's got to be sudden, unexpected. It's unusual. And you have to identify the event that did it, like a storm, hurricane, earthquake, flood, or fire. An example, I had a client with a house up in the San Mateo Hills. It was sliding down the hill. And so she claimed a casualty loss for that. And then she got audited. Well, the insurance wouldn't cover it for whatever reason. They didn't cover it. And she claimed a casualty. Well, the thing is, and we were trying to blame it on the storm or something like that, but she lost the audit. How did she lose the audit? She got paid by the contractor who built the house. And I said, I needed to know that. You couldn't deduct it if you got reimbursed. Well, she said, well, he said it was a confidential settlement. I couldn't tell anybody. No, you're supposed to tell me, because that was really embarrassing at the IRS, because you can't deduct a loss if you got reimbursed. So got to watch out for that. So what doesn't qualify? Accidentally breaking items, damage caused by pets, your dog knocking over that Ming vase. If you set the fire, you pay someone to set the fire. Progressive deterioration, damage caused by drought, moth, fungus. I can't believe we're at 305 already. So I'm going to have to buzz through pretty quickly here. So anyway, the other benefit of owning a home is you get some tax credits, residential energy efficient credits. Currently, they're at 26%, and it's going to drop down to 22%. But President Biden's really in favor of these things, so that might go back to 30%. So solar electric property, heat pump, geothermal heat pumps, turbines, fuel cells, and those kind of things. So energy credits. We're not going to talk about rental property now. We're kind of out of time on that. Medical necessary improvements. So if you have to modify your house for medical reasons, and one of my clients had to do that. He lost his leg because he had a medical incident and he lost his leg. He lives in a multi-story house in San Francisco. I know it costs $18,000 to put an elevator in your house. So we deducted that as a medical necessary expense. And then also his bathroom had to be modified and all that. So we deducted as a medical expense. Can't double count that as basis to the home, but adding grab bars, modifying the doorway, adding an elevator, those kind of things would qualify. Elevator, HVAC with special filtration, handicapped access. We had a client, I got a prescription from a client. The doctor says this client needs a hot tub. So we deducted the hot tub because it was a medical necessity according to the doctor. We talked about selling a home in our last webinar, so we'll have a link to that. So we're not going to spend much time going over this here. We're going to close with there's been a debate about, should I stretch to buy a house, right? Should I buy now? Should I wait? It depends on who you ask, right? The proponents of buying now is rates are really low. House prices aren't probably going to go down. You'll grow into it. Your income's going to get better. You're going to get promotions. You're going to get more bonuses. You're going to build wealth. The people said, wait, well, we don't count on house prices continue to rise. There's an article in Friday's paper about some real estate markets are softening. Houses are being bought below asking price. So in some markets, they're softening. I don't know about here, but in some markets in the United States, they're softening. And the seller's market must shift to a buyer's market. What if you're concerned about your job stability? So what do you think, Kateryna, when your client says, I'm going to stretch to buy a house, I'm just going to eat rice and beans?
Well, I think every situation is unique. And as we talked extensively today about the down payment, sometimes it makes sense if you have a job stability, you have been employed, and then the prospects of you staying with the job are looking good, then I would strongly encourage, talk to the CPA, talk to the mortgage broker and see if it makes sense for you to buy, because sometimes you are in a position, there are some good loans with as low as 10% down payment.
Right.
So, and we discussed already the benefits of home ownership. But if you have an unstable situation where you are still working on your credit, you are still building on your down payment, maybe it makes sense to rent in the area where you potentially want to buy, and then get to know the area and then see if you like it, because with rental you have more flexibility and less responsibility to maintain the property. So my answer to that question, it depends, because everybody's situation is unique.
But something to consider, and we've done this quite a few times with different clients, is a lease option. So I can rent your house. I love this house. I'll rent it, and you work out a deal. Generally, you make a 10% non-refundable deposit to lock in the deal. You have to draft the agreement and all that, and a portion of your rent is applied towards the down payment. So you get a credit for that. So the point about that is that it gives you a disincentive to walk away from the house, because I just built up this down payment. And but the thing is, surprising thing, because that a client, that was their business. They were a real estate developer, and they did lease options. And nearly all those people walked away from their lease deposit, their deposits. I couldn't believe that. I said, really? That's a really big incentive. At the end of 3 years, you've got maybe $30,000 towards the down payment. That's a pretty good deal, but I don't know. But anyway, lease option is a possibility. Depends on the market, right? If it's a seller's market or a buyer's market. Types of homes. We're not going to go into too much detail. I can't believe time goes so fast. I think we're having too much fun here. Well, we saw the news in Florida, right? That the condominium that collapsed. How scary is that? I hope we don't hear that story here in California, but homeowners associations. So it's a private entity. They're usually tax exempt, and it's not government. It's a private organization. It's formed to make rules for a community or a jurisdiction. I'm here in River Shores. I'm part of 3 homeowners associations. I have the homeowners association for my development, and those dues pay for the common area, the driveways, the fountain, and the landscaping. Then we have the Redwood Shores Homeowners Association. And then we have the Redwood Shores Owners Association. And I keep forgetting which is which. One's the nice one and one's the mean one. The nice one is the one that puts on the Santa Claus and the Halloween parade and all the fun stuff, the community stuff. They do enforce certain rules. The other one is very strict on rules about what color your houses are and all the community type things here. But if you're buying a house that's subject to a homeowners association, highly recommend read the minutes. For the last few years, read the minutes, read the financial statements. If you don't know how to read them, get an accountant to read them. Because if you saw those Surfside Association minutes and the financial statements, you would have been totally frightened, because they didn't have any reserves. And there was some acrimonious debates on the board about all the repairs they were supposed to make. They started talking about this 12 years ago. So it's been going on for a long time. And the assessments would have been huge, because the longer you wait, the assessments get bigger. So there's nothing wrong with the homeowners association per se, but make sure it's well run. It's got a good property manager, that everybody's paying their dues and everybody gets along. So that makes sense. A client's son, impetuous young man, he insisted on buying a condo. I said, did he look at the minutes, the association? Well, guess what? Substantial damage was to the property. The assessment was around $50,000 per unit. Well, the thing is, if you read the minutes, you would have known about that. And he didn't read the minutes. If you read the financial statements, you must saw the reserves were too low for that development. So of course he didn't talk to me. I wish he did. I would have talked him out of buying that condo. So, so he got stuck with the big assessment. And of course the 50,000 was on the low end. The assessment turned out to be $150,000. That was obvious. It's black and white in the minutes, but read the minutes. Read the minutes. We're kind of running out of time, so I'm not going to talk about working from home. Bottom line is, a lot of us are working from home. If you're an employee, you don't get the deduction because that deduction has been eliminated. But if you're self-employed, you can. I think this is my last topic. Again, people who are having a tough time getting a home, I've had quite a few people take advantage of this. It's called a share equity financing arrangements. A son or daughter goes in on a house with their parents, or a nice uncle or grandparents or whatever, and they get in on a house together, and basically the parent would rent the portion they own to the child, and over time the child's going to build up some equity. Then hopefully he can refinance later and pay off the parents. But the shared equity financing arrangements, it's another way of getting into a property. So it's something to consider. So it is possible to buy a house in the Bay Area. People keep dismissing that. Don't pay attention to what you hear in the news or in the media. It's very possible to buy a home. Take some planning, working with a good mortgage broker, a good realtor, and a good CPA, right? So it's a team effort. So I think that's our last. I had another slide on buyer's remorse. A lot of articles about buyer's remorse because, right, a lot of people made hasty real estate. It's a hot market, and there's some stories of people who just bought a house sight unseen. Well, you bought a house, you can't go back to Costco to return it. You can't just return the house to seller and say, it's not what I thought it was. Can you have it back? Get a property inspection. I highly recommend it. Best money you would ever spend. And I always highly recommend going with the inspector. They're really good at it. They're really good at catching things that you and I probably won't catch. There's a story of a homeowner. She didn't get a homeowner's exemption, a homeowner's inspection, a property inspection. She had to spend $3,500 getting rid of the bats that were in the house. Talk to the insurance agent. Can you get insurance at a reasonable cost? Look at the property in the daylight. There's a house that the woodpecker found the side of the house and put, acorns in the side of the house. Costs a lot of money to pull those out and fix the side of the house. And this is a situation that happened to one of my clients. Hang out the property for some time. Aircraft noise. SFOs changed their flight routes because we have this new radar system now, so you can land two planes at the same time. Well, they changed the way planes are landing, so your neighborhood might have been a really quiet neighborhood. Well, now you got a big jumbo jet cruising over your neighborhood making a lot of noise. And this specific house I was thinking about is in Los Altos. I didn't know that. I thought they turned the engines down when they're gliding down the SFO, but it was incredibly noisy. I just told him, once you get those big triple pane windows, maybe that would help. So look at the property. Steps to buying a home. I think we talked about all these steps here. Don't overpay, don't panic. And here's a list of our previous webinars. Easiest way to find these is my YouTube channel. Just type in Larry Pond CPA on YouTube. You'll find all these webinars we've done in the past. And we look forward to doing more with you in the future. And thank you for attending.
Larry, do you have some appetite to take a few questions, or shall we leave it for the email time?
Oh, let's take a look at the questions we have.
I think Irene's question was, remember, we promised her to get back at the end of the seminar.
Was that Irene? Was that Irene? Who was that?
Yes.
Was that Irene. Hi, Irene. Thank you for coming. Appreciate you coming. So Irene has a really good question here. When filing a final tax return for a decedent, what records does the executor need to claim from the house sale a deduction for upgrades such as remodeled bathroom, kitchen done by the decedent? Well, that's a good question. I'm going to make a major assumption here. The assumption is that the decedent was the owner of the house, and as such, she would qualify for a step-up in basis. And the step-up in basis is equal to the value at the date of death. So you get the appraisal figure out the date of death value, it's stepped up. So that's the number used for the cost basis. Now you add to that any improvements, repairs, fix up expenses before you sell the property. So those are costs after date of death, but before sale that you can add to that. So, but the remodeling and all that, that's irrelevant because that's all being covered by the step up in basis. So I hope that helps, Irene.
Let's see, there were a number of other questions. In the Q&A, there was, can you clarify the one third of gross or net income?
Well, that's that's a rule of thumb, when it comes to figuring what your housing costs should be. It's like, especially when we're dealing with our younger people, like my kids or whatever, right? It's like, no, you're not going to rent a $6,000 a month apartment. Like, I mean, that doesn't make sense, right? So it's just a rule of thumb, So if my cash flow is $6,000 a month, a third of that's $2,000. So then that gives me a clue that that's about the range of what my rent should be in terms of housing costs. I mean, if I make $6,000 a month, I shouldn't be renting a $6,000 a month place. So, these are just rules of thumb that we use for financial planning. So I know many people here in the Bay Area certainly pay more than a third of their discretionary cash flow for housing costs. And we can get really technical about that if you want to, like, what does that really mean? Does that include my bonuses? Does that include my commissions? Does that include my stock gains and all that? I think that's really a personal question. It depends on your situation. What do you think your housing costs should be?
And also I want to share, for example, when we are screening the tenants that we are helping the landlord to rent their place, that usually we look at the income of the prospective tenants 3 times the rent. So say, for example, the rent is $3,700, then we would look for somebody with a gross monthly income at around $11,100.
Yeah, something like that. I mean, we don't. Yeah, we don't want to don't make, because the risk the mistake a lot of people make is and I've seen this happen. One client, he had a great year. He was in sales, made a huge commission, so he had a really massive W-2, and the salesman sold him a house based on that W-2. Well, he doesn't get that W-2 every year, so guess what? He got in trouble a couple of years later. He couldn't afford the house. So that person basically did a disservice to him, I think. And the people selling the property were rubbing his ego, saying, "Look, this house you can get. This is a beautiful crib. Come on, a man of your stature should get something like this." So I guess he kind of fell into that ego. But you don't want to get a property you can't afford. You just got to be careful about that.
Exactly. And then also from the same person, can you explain the mortgage deduction with an example? And then there is an example. If I make $100,000 annually and buy a house for $200,000 and pay 20% down, and I'm paying a monthly mortgage, what am I deducting and from what?
Yeah. So the house deductions are what's called itemized deductions, and that's reported on Schedule A of the tax return. So what's included in there would be the property taxes. Current law is that state and local taxes limit to $10,000. So even though you might be paying more than $10,000, the deductible limit is still $10,000 under current law. Now, there's about 32 Democratic Congress members that refuses to sign President Biden's infrastructure bill unless they repeal that. So we'll see if that's going to happen or not. Don't know if it will. If I'm a betting person, it's $10,000 if you're single, $10,000 if you're married. I think they might compromise and make it $20,000 if you're married. So we'll see if that would happen. The other deduction is the mortgage interest. So it's not the payment that you make, it's the interest on that mortgage. So for example, you buy a house for $200,000, pay 20% down. So 20% down would be $40,000. So that's $160,000 mortgage. So $160,000 mortgage, let's say it's 3%. So I have a calculator here. I can't do it in my head. So that's $4,800 of interest. So that $4,800 is added to your itemized deductions. Now, one consideration for taxes to consider is that as a result of the tax change that took in effect in 2018, the standard deduction has been doubled. So for a married couple, it's got to be at least $24,000 or $25,000. For a single person, it's got to be at least $12,000. So even though if you have a small mortgage, it's probably not going to make a difference on your taxes. So it's going to be a bigger mortgage. It's going to make a bigger difference. So the value of the house tax deductions is not great as what it used to be under the old law before 2018. But tax laws change all the time. So we'll see what's going to happen in the future. Yeah, so someone, anonymous attendee says, with standard deduction increase, what mortgage interest, property tax, other deductions will let one itemize? So Schedule A. So you go take a look at Schedule A. The lines include medical expense deductions. So you have medical expenses in excess of 7.5% of your income, state and local taxes to a limit $10,000, mortgage interest deduction, charitable contributions, and that's basically it for now. So those are the general deductions. So anyway, we've gone way over time here. So so Kateryna, any closing thoughts?
Well, it looks like that our webinars, we have done a tandem of a few, and they are very popular. I just want to encourage the attendees that if you have any other topic that you are interested in, do let us know, and we'll do our best to put up a webinar or maybe a seminar in the near future. Who knows? Things are opening up. Larry, thank you so much for your time. I know Nancy, one of the attendees, she's saying that please offer soon a selling webinar. We do have a webinar on tax aspects of selling a home, but that would be good. Maybe I'll put a webinar together on actual selling a home and what the steps and what pros and cons, so that you do everything, all the planning in advance, and then you will enjoy the benefits of a good planning. Anyway, thank you so much for attending. I will follow up with everyone and send out a handout material. If you want to see the handout material now, Larry shared with everybody a link to the Google Drive, so you can access it now or wait for my follow-up email to download it later. Thank you everyone for attending. Larry, thank you for all the knowledge that you are sharing with everyone. It's all useful and appreciated.
Yeah, we went way over time. Sorry about that. So it's going to be almost an hour and a half. So there's certainly, as you can tell, there's a lot to talk about and there's a lot to discuss. And today we just focused on buying and owning a home. Last time we talked about selling a home. And then before that, we talked about all the different considerations when you sell a home with a big gain. And then we talked about Prop 19 back in January. So, and we can certainly look forward to doing more with you. Let us know what topics you like to see. I enjoy doing this. It's a lot of fun. And thank you very much and enjoy your day. Thank you.
And one more reminder, if, for example, you need time to go back to the webinars, do go to the YouTube channel of Larry, and you can easily access all the webinars in the comfort of your home with just a click of the button. Larry, yeah. Maybe you can share with everyone the link to your YouTube channel.
I am doing that right now. Yeah, and I post financial literacy topics in there. So, you know, so there's my YouTube channel, what's publicly available. There's actually quite a bit more that's not publicly available. There's a little more my continuing education, because I do a lot of teaching to tax professionals and financial advisors. So I really enjoy doing that. So thank you very much. And also, well, I might as well make a plug here. I am now the chair of the statewide financial literacy committee for the California Society of CPAs. And we are planning to do Financial Fridays, a YouTube video series of our CPA volunteers of any financial literacy topics. If you've got a topic you'd like us to do, we'll certainly do that. And we're going to try to get out and start doing this in the public. We're actually learning how to talk to live people instead of this webcam here. And it's certainly a lot more fun because I missed the applause. Yeah, thank you. Thank you. All right. Well, thank you very much. I'm going to end this right now, and I'll see you again, Kateryna.
Thank you so much, everyone, and be safe.
All
Bye.
right, thank you. Bye-bye.